So you wouldn't be afraid to invest at the latest valuation, which is $47 billion post-money?
I wouldn't be afraid at all. I mean,
Thank you, Ashton. It's amazing.
Blockbuster, founded by David Cook, went from about $5 billion in market cap to bankruptcy. Theranos by Elizabeth Holmes went from a max valuation of $10 billion to zilch. But none of them compare to WeWork, led by Adam Neumann, as it went from $46 billion to bankruptcy. Yet Adam walked away with more than $2 billion in net worth as the company struggles to make ends meet. How did it get to this point? How did Adam Neumann get away being a winner as his investors suffered? Humble beginnings. WeWork, or should I say the We Company, got a fancy name upgrade during its peak in 2019 to represent its expansion to education and other industries. It was the brainchild of a 44-year-old Israeli-American entrepreneur named Adam Neumann. Now, here's where it gets interesting. Before diving into revolutionizing office spaces, Neumann kicked off his career promoting something entirely different. Crawlers, a line of baby clothes that rocked sewn-in knee pads. It all kicked off in 2010 when Neumann and Miguel McKelvey founded the company. Now, Adam and his American partner Miguel weren't newcomers to the co-working scene. They had previously created Green Desk, an environmentally conscious co-working space in 2008. But, ready for a new venture, they sold Green Desk and rolled the proceeds into what would become the co-working giant we know as WeWork. The rise of WeWork. Ever wondered if an office space could be more than just desks and chairs? Well, that's exactly what WeWork set out to prove. Branded as a real-life social network, they didn't just offer workspace. They envisioned a whole We universe. Gyms, co-living spaces, and even schools. They wanted to transform the way we work and make it an experience. And guess who joined the party? Adam's wife, Rebecca Neumann, became the chief brand officer and created WeGrow. Talk about taking co-working to a whole new level. Now let's dive into what made WeWork the talk of the town. Sure, office subletting wasn't a groundbreaking idea, but WeWork brought a fresh take to the game. Their spaces weren't just about function, they were designed to be creative, collaborative, and aesthetically pleasing. The rental terms? As flexible as a gymnast, with monthly options that kept everyone happy. Initially attracting freelancers and small companies, WeWork quickly became the go-to for larger companies like Salesforce and Microsoft. Need overflow office space or want to experiment in a new location? WeWork had you covered. They weren't just providing a place to work, they were creating a trend that appealed to businesses of all sizes. It's fascinating how WeWork revamped the workplace aesthetics, making it more inviting and adaptable to different work styles, isn't it? But WeWork's ambition extended beyond being a mere office space provider. It positioned itself as a disruptor in the league of tech giants like Uber and Airbnb, not just for offering in-demand services, but also for achieving sky-high valuations, akin to these unicorns. This community company model aimed to revolutionize the sharing economy, marking a significant shift in how we perceive workspaces. But hold on a sec, how can a company dealing with office spaces soar to such heights in just a few years? Well, let's rewind a bit. Picture this. In 2014, WeWork wasn't just launching offices, they were practically launching a new location every month, hitting a whopping 10 a year. Fast forward to 2019, and they were not just a local hotspot. They had locations in dozens of countries, becoming the largest commercial tenant in Manhattan. The company's valuation? Oh, it wasn't just hitting millions. It soared past the billion-dollar mark in 2014. With backing from SoftBank Group, WeWork's valuation reached a jaw-dropping $47 billion, setting the stage for a blockbuster IPO. Reality check. As the excitement for WeWork's IPO built up, some skeptics couldn't help but ask why an office subleasing company was commanding such an astronomical valuation. But Adam Neumann had an answer. He saw WeWork not just as an office space provider, but as a tech company. He argued that the rapid growth, coupled with heavy reliance on technology, justified valuations akin to the tech industry giants. Picture this. Talks of the IPO valuation reaching a mind-boggling $100 billion. Now that's a number that turns heads. Little did they know this was just the beginning of a roller coaster ride for WeWork. where the winds of change were about to reshape the narrative and challenge the very foundations of its colossal valuation. Ever wondered what happens when ambition meets impulsiveness in the corporate world? Well, enter Adam Neumann, the visionary behind WeWork. Despite the grand dreams for the company, Neumann's leadership style raised some eyebrows. Imagine suddenly banning meat at the office without any clear explanation. Talk about an unexpected change in the workplace menu. Oh, and the ban didn't seem to apply to Neumann himself, who was caught red-handed enjoying a steak after the proclamation. But that was just the tip of the iceberg. His impulsive tendencies didn't stop there. Rebecca Neumann, his wife and WeWork's chief brand officer, reportedly fired employees on the spot just based on their energy. Can you picture working at a place where the CEO bans meat out of the blue, but then you catch him munching on a burger? Silicon Valley tech companies are demanding, but WeWork was this whole other beast. Neumann's behavior wasn't just unpredictable, it bordered on financial conflict. He trademarked the word "we," insisted on rebranding WeWork as the We Company, and then charged his own company a whopping $5.9 million just for using the trademark. And hold on, he didn't stop there. Neumann used a chunk of a $500 million personal credit line to buy a stake in buildings where WeWork leased office spaces. Talk about blurring the line between personal and professional interests. As WeWork continued its meteoric rise, more red flags started popping up. From labor disputes in 2015 to laying off 1,000 employees in the following year, the company faced turbulence. And let's not forget the unforgettable all-hands meeting in 2016. Firings explained, followed by shots of tequila and a private concert by Daryl McDaniels of Run DMC. Just a tad unconventional, right? Ever been to an all-hands meeting that ended in a tequila-fueled concert? WeWork's management style was definitely one for the books. As if that weren't enough, multiple former executives sued WeWork in 2019, alleging gender and age discrimination. Yet additional investments fueled an intensified focus on rapid growth. Converting a plain office space into a trendy WeWork spot required extensive renovations, adding to the startup costs. The company aimed for growth first and profits later, resulting in staggering losses. $1.9 billion in 2018 and over $2 billion in 2019. That's roughly $5.5 million down the drain every single day. However, private investors seemed willing to bear the financial burden, cheering on the growth trajectory. But when the company filed for IPO in August 2019, it was like the public hit the brakes. Concerns about the business model, Neumann's behavior, and a laundry list of conflicts of interest prompted a delay and eventual withdrawal of the IPO. The fallout was swift. Neumann stepped down as CEO, and by May 2020, WeWork's valuation plummeted from a peak of $47 billion to a mere $2.9 billion. Let's look at this chart. How would you react if your company, once valued at billions, suddenly faced public skepticism and the CEO had to step down? The WeWork saga was a roller coaster of highs and unexpected lows. Yet the drama continued. By August 2020, WeWork aimed to turn profitable by 2021, but there was a catch. The company had to slash its workforce by a staggering 60%, going from 14,000 employees in 2019 to just 5,600 in 2020. Private investors might have tolerated the losses, but the general public wasn't buying it. Yet despite this turmoil, WeWork boldly went public in October 2021 by merging with the blank check company BowX Acquisition Corp via a SPAC merger, but faced an uphill battle and bouncing back from the intense scrutiny that followed. The pandemic dealt a significant blow, causing a ripple effect on its occupancy rates, which, despite efforts, failed to rebound, stagnating at a modest 72% as of its latest quarterly update. WeWork's bankruptcy and aftermath. Following the canceled IPO, SoftBank stepped in with a $3 billion bailout package in October 2019, aiming to salvage the sinking ship. However, this lifeline was retracted in April 2020 due to unmet conditions, sparking legal battles. Lawsuits flew in from multiple directions, first from the WeWork board, then from Neumann himself, adding a layer of complexity to the company's woes. So, after WeWork's grand IPO dreams crashed and burned, Guess who came out on top? Yup, you guessed it, Adam Neumann. Yes, after WeWork's IPO went bust, Neumann got the boot, but emerged as a big winner in a deal that turned him into a billionaire. That's right, he's now sitting on a hefty $2.2 billion. Meanwhile, the reins of WeWork were snagged by SoftBank, the Japanese powerhouse investor. But here's the twist, the company's value after the takeover plummeted, falling well short of the colossal $13 billion that SoftBank had pumped into it. The big losers in this drama were SoftBank and the Saudi Sovereign Wealth Fund, the heavy hitters backing SoftBank. And let's not forget the 12,000 WeWork employees caught in the storm. Just when WeWork thought the worst was over, the COVID-19 pandemic dealt a severe blow. By March 2020, the company's credit rating plummeted from B- to CCC+, dangerously close to default. With $47 billion looming in future rent liabilities, the pressure intensified. Fast forward to 2023, the departure of CEO Sandeep Mathrani in May heightened concerns. By August, WeWork openly admitted to having substantial doubt about its survival, burdened by staggering long-term debt and leases totaling billions. In a dramatic twist, WeWork found itself on the brink of bankruptcy in October 2023. Unable to meet interest payments on its loans, the company filed for Chapter 11 bankruptcy in a New Jersey court. It's not the end. It's a strategic move to restructure debts and address legacy leases. Filing for bankruptcy shields WeWork from creditors and landlords while it hammers out a plan to repay its debts. The company's immediate focus is on ensuring business continuity while shedding non-operational leases. The current CEO, David Tolley, remains optimistic, aiming for a phoenix-like rise from the ashes of bankruptcy. In a world embracing remote work and flexible office spaces, WeWork might just find a way to adapt and revive itself. But the cautionary tale of WeWork serves as a stark reminder that rapid growth, coupled with tech buzz, is no substitute for a rock-solid business model and sound corporate governance.